All too often, we distill the idea of a good investment to simply buying low and selling high. When deconstructed, however, investing is more involved and follows three distinct steps. Regardless of how sophisticated the investor is, consciously or unconsciously, they all follow the same script. Step 1, thesis. An investment begins with a thesis or idea. This could be around the future state of a company, sector, commodity, demographic, climactic state, or even political situation. The list is wide open. As an example, you could say that Toronto receives over 100,000 people every year, but only builds 35,000 units of housing each year, of which 85% are condos. Therefore, demand outstrips supply, and prices will naturally rise. Conclusion? Buy Toronto real estate. Or, electronic vehicles are set to take over the roads, and therefore the price of the minerals that go into the batteries, such as lithium, nickel, cobalt, manganese, and graphite, are set to jump. Conclusion? Buy a cobalt mining company. Both examples are what well-known investor Howard Marks would say is first-level thinking. He suggests that examples of first-level thinking don't provide true insight into the investment, and in fact are consensus views. It is second-level thinking that brings novel, counterintuitive perspectives that can generate an investment gain. As taken from his "It's Not Easy" memo, first-level thinking says, well, I think the company's earnings are going to fall, so sell it. Second-level thinking says, I think the company's earnings will fall less than people expect, and the pleasant surprise will lift the stock, so buy. Step number 2, expression. Once you have your thesis nailed down, you need to find a financial method to express it. How are you going to derive an economic gain from your perspective? Is the vehicle a stock, bond, real estate, or commodity? Simply because your analysis tells you that oil is set to rise, I'm not sure you're going to rent an oil tanker and captain it across the ocean. A fitting example of finding a financial expression was highlighted in the movie The Big Short. Here, Michael Burry, the hedge fund investor played by Christian Bale, saw that the US housing market was extremely fragile and was poised to collapse. Okay, he got the analysis right, but how is he going to financially express that point of view? At the time, nothing existed to bet against the housing market. So what did he do? He went to Goldman Sachs and had them create a vehicle to do just that, called a credit default swap on a select group of mortgage bonds. In hindsight, they thought they were simply taking his money. Step number 3, timing. Timing is probably the toughest of all three and needs to be viewed with regard to time, yes, like days, months, and years, but it must be underlined by valuation. Suppose that you're confident in your thesis and you found a way to express it. Perfect. But how's the valuation? Is it too high? In those situations, it can be very tough, but you must be patient and wait. I started in financial services at a mutual fund company on February 24th, 2000, only a few weeks before the internet bubble burst. The frenzy of tech and internet buying was everywhere. The marketing materials promoted that in the near and medium term, we would all be on high-speed internet with cables running across the globe, that we would be shopping for all sorts of online products, and that cell phone and smartphones would find their way into every hand around the globe. Look around. The thesis was accurate and came true. And in fact, there were equities of tech companies to express my viewpoint. The trouble was timing. The valuations were out of control. Had you bought the NASDAQ when I got my first stack of business cards, it would have taken you 14 years to recover, despite every forecast coming true. And by that time, my business cards were becoming a thing of the past. It is usually the timing, and more specifically valuation, that can get us into trouble. Bottom line, investing is difficult and should be approached with humility. If anybody has a sure thing, be skeptical. As you can probably tell, I love this stuff. And if you want to talk about it more, please give me a call.